Welcome to the Daily News Update. We've got 7 major stories crossing the AI landscape today, and they paint a picture of an industry in rapid transformation. We're diving into forecasting pipelines with TimeCopilot, examining the local LLM wars and why power users are abandoning Ollama, exploring a parameter efficiency breakthrough that challenges everything we thought we knew about scaling laws, and then stepping back to look at the broader labor market, enterprise adoption, the talent competition between OpenAI and Anthropic, and finally, a sobering geopolitical scenario about Europe's AI future. It's technical, it's strategic, and it's consequential.
That's quite a day. What I'm hearing is this isn't just another week of AI news. There's a through line connecting all 7 of these stories. We're talking about who controls capability, who can keep pace with adoption, and frankly, who wins and who loses in the next few years. Some of these are deep technical dives, but others are showing us real-world consequences for businesses and entire regions.
Exactly. The London Business Survey alone is revealing 75% of firms are already using AI, but half of them report skills gaps. Meanwhile, Samsung is deploying ChatGPT Enterprise to their entire global workforce. Anthropic and OpenAI are fighting over talent and capability positioning. And Europe is facing a scenario that reads less like science fiction and more like realistic trend extrapolation. We'll unpack all of it, but the core theme is this. AI adoption is accelerating faster than institutions can adapt. Capability advantages are widening, and the geopolitical and economic stakes are becoming real.
So buckle in. We've got everything from the nitty-gritty of local inference optimization to the trillion-dollar questions about European sovereignty and labor market disruption. Let's start with the technical foundation and work our way up. First stop, forecasting pipelines and how they're changing the game for traders and analysts. So TimeCopilot is one of those tools that really caught my attention because it solves a problem a lot of analysts and traders face. They've got all these different forecasting models, statistical ones like AutoArima and AutoETS, then Profit for trend decomposition, and now foundation models like Chronos and TimesFM. But they're all different APIs, different interfaces, different ways of thinking about the problem. TimeCopilot puts them all under one roof, with a unified interface. You build your pipeline once, and it works across the entire ensemble.
That's interesting, but I want to ground this in reality. If I'm running a trading desk or a derivatives operation, how does this actually change my workflow? Are we talking about something that meaningfully improves signal quality, or is this more about convenience?
It's both, actually. The real power is in the rolling cross-validation framework. Instead of fitting your model once and hoping it works, you're backtesting across multiple time windows, measuring performance with multiple error metrics. We're talking MAE, RMSE, MAPE, and then building an RMSE leaderboard that tells you which model configuration actually performs best on your specific data. For trading, that's critical, because markets change. You need to know which model was working in the last 6 months, not just which one looked best historically. And then the system ranks them automatically and lets you pick the winner or blend them.
Okay, so you get transparency into what's actually working. But here's my question. What happens when your models disagree? You've got statistical models pulling one direction, Profit sees a different seasonal pattern, and Chronos, a foundation model trained on millions of time series, is pulling somewhere else entirely. How does the tool handle that divergence? Is it averaging, weighting, or are you still making that decision yourself?
Great question. And this is where the probabilistic forecasting piece becomes essential. Each model generates not just a point forecast, but prediction intervals. 80% and 95% confidence bands around the forecast. So when they disagree, you're not just seeing point estimates, you're seeing the uncertainty each model assigns to its prediction. If one model is highly confident and another is hedging with wide intervals, that tells you something about whether the disagreement matters. And then on top of all that, the system runs automated anomaly detection across the ensemble at a 99% confidence level. That flags unusual observations that might be throwing the models off.
So the tool is giving you both the models and the guardrails around them. But I want to push on this. Is TimeCopilot democratizing sophisticated forecasting, letting anyone build robust trading signals without years of statistical training? Or is it hiding complexity under a convenience layer? Because these models don't agree for a reason. Understanding why they disagree is where the alpha often lives.
That's fair. I'd argue it's somewhere in the middle, and it depends on how you use it. If you treat the leaderboard as gospel and just pick the top-ranked model, you're hiding complexity. But if you use the unified interface as a way to systematically test hypotheses about which models work for which types of forecasting problems, and the anomaly detection flags unusual regimes where the normal rules break, then you're actually gaining transparency. The rolling cross-validation forces you to think about how your model performs across different market conditions, not just on the data you trained it on. That's the opposite of hiding complexity. That's surfacing it in a structured way.
Now let's talk about something that's been brewing in the local LLM community, and it's getting heated. Ollama has become the go-to tool for running large language models locally, right? But there's a growing chorus of power users arguing that convenience is hiding some serious problems. The core issue is attribution. Ollama built its entire foundation on llama.cpp, the open-source inference engine, but a lot of users don't even realize it. The community friction over that is real. Beyond that, you've got performance trade-offs, model availability delays, and what some are calling a philosophical drift from the original local-first principles.
Okay, I hear the attribution point, and that matters for open-source integrity. But let me push back on this a bit. Ollama solved a real problem. Before Ollama, getting a local LLM running meant dealing with complex configurations, multiple tools, figuring out quantization formats, managing downloads. Ollama wrapped all that complexity into something you could do in 30 seconds. Isn't that convenience worth some friction in the developer community?
That's fair on the surface, but here's where the benchmarks start to matter. Direct llama.cpp deployments often deliver higher throughput than equivalent Ollama setups running on the exact same hardware. So you're not just getting convenience, you're potentially paying a performance penalty for it. And then there's the model availability lag. When a new gguf file drops on Hugging Face, these are the quantized model weights, you can use it immediately in llama.cpp. Ollama users have to wait for the registry to update, which can take days or even weeks. For people who want to experiment with cutting-edge models, that's frustrating.
So it sounds like the complaint isn't really about convenience itself, but about the hidden costs of that convenience. You're trading some performance, you're waiting on model updates, and there's this philosophical issue of not knowing where your tool actually came from. The question becomes, for serious users, the people building systems that actually need to scale or iterate quickly, Ollama's abstraction layer might be more burden than benefit. Is that the argument?
Exactly. And critics point to alternatives that give you more granular control. Direct llama.cpp if you want raw performance, LM Studio for a GUI that's still transparent about what's happening under the hood, Jan for a more feature-rich local deployment, Kobold CPP for text generation workflows, or Llama which lets you bundle everything into a single executable. Each has different trade-offs, but they all give you visibility and flexibility that Ollama abstracts away. There's also this cloud service integration thing with Ollama that raised some transparency concerns. When are your prompts staying local versus getting sent somewhere remote? That matters for people who care about privacy or security.
That's a real concern, especially for people working with sensitive data or building production systems. So the deeper question here is, what do power users actually need? Is it simplicity and ease of use? Or is it transparency, speed, and control? Because those are competing values, and Ollama optimized for simplicity. The alternative tools optimize for the other things.
Right. And I think that's where the market is actually sorting itself out. Ollama is probably great for someone getting started, playing around, curiosity-driven. But if you're building something that matters, a production inference pipeline, a business that depends on low-latency responses, a research project where model iteration speed matters, you need visibility into what's actually happening. You need performance that doesn't leave compute on the table, and you need to know exactly where your data is going. For those users, the abstractions that made Ollama convenient become sources of friction. The philosophical point underneath all this is about local first principles. If you're running LLMs locally, shouldn't you own the entire stack? Ollama kind of breaks that because you're dependent on their registry, their abstractions, their release schedule. All right, we need to talk about something that's been causing a stir in the AI community this week. Weibo AI released a model called Vibe Thinker 3B, 3 billion parameters, and it just scored 94.3 on AIME 2026, which is the American Invitational Mathematics exam. To give you perspective, that score matches DeepSeek v3.2, which has 671 billion parameters. So we're talking about a model that's 200 times smaller, achieving the same performance on a very hard math benchmark. The claim from the team is that this isn't accident or noise. They're arguing that reasoning itself is parameter dense, meaning you can compress it into a small model, while general knowledge is parameter expansive, meaning it requires scale.
Okay, that's eye-catching, and I understand why people are excited. But I want to ask the skeptical question immediately: how much of this is a genuine breakthrough in parameter efficiency, and how much is this model just gaming the AIME benchmark? Because benchmarks have become incredibly easy to optimize for. You can build a model that's amazing at one specific test and terrible at everything else.
That's the right question, and the evidence here is actually mixed in a way that's interesting. So they built this model through a 4-stage post-training process on top of Qwen 2.5 Coda 3B. They did curriculum-supervised fine-tuning, then reinforcement learning, then domain-specific math reinforcement learning, then test time scaling. When you look at the results, the math and code performance is genuinely strong. It's matching or beating models way larger. But here's the red flag. They tested it on GPQA Diamond, which is a knowledge benchmark, and it scored 70.2, while Gemini 3 Pro, which is much larger, scored 91.9. So the model is not just generically better, it's specifically good at reasoning tasks, but weak on knowledge tasks.
So, the hypothesis they're presenting, that reasoning is compressible and knowledge requires scale, that's actually supported by their own benchmark results. Reasoning tasks compress down, knowledge tasks don't. That's not a breakthrough then. That's just a different optimization choice. They optimized for reasoning at the expense of knowledge. That's different from saying you can get general intelligence at 3 billion parameters.
Exactly. And that's where the community reaction splits. One camp says, this is exactly what we'd expect if we're carefully designing the training pipeline for specific capabilities. Of course, reasoning compresses more than factual knowledge. The other camp is more excited and says this represents a genuine compression breakthrough that challenges the scaling law paradigm that's been dominating AI research. They point to the math scores and say, look, if we can get this kind of reasoning capability in 3 billion parameters, maybe we've been overestimating how much scale we actually need. The philosophical disagreement is really about whether this changes the fundamental trajectory of the field or whether it's just smart optimization within existing scaling laws.
So, what does this actually mean for someone building products, especially builders working with tight compute budgets? Because that's where this gets interesting. If VibeThinker 3B can run locally and handle reasoning tasks like math, code generation, logic problems, things that ordinarily require huge cloud models, that actually changes what's possible for a solo builder or a small team, right?
That's the practical payoff, and it matters. If the reasoning compression is real, then yes, you can deploy sophisticated reasoning locally without GPU farms. But here's the caveat. This model is specifically optimized for math and code. You probably can't rely on it for general knowledge tasks, customer support, or nuanced writing. So you'd need to be strategic about which parts of your pipeline you run on Vibe Thinker 3B and which parts you still offload to larger models or cloud APIs. But for specific workflows, like code generation or mathematical problem solving in a product, you could potentially get serious capability with a very small footprint. The question is whether that specialized strength is enough for your use case, or whether you need the generalist approach of a larger model.
Now let's look at something that's happening in real time across London's business landscape. We've got a survey of over 2,000 businesses, and the numbers are really revealing what happens when AI adoption accelerates faster than workforce training can keep up. So here's the headline: 75% of London firms are already using AI in some form. That's a massive adoption rate. But, and this is important, 50% of them report AI-era skills gaps. That's up from 36% in 2025. So year over year, the severity jumped significantly.
Wait, that's a paradox right there. You're telling me 50% have skills gaps, but earlier you mentioned that job vacancy filling difficulty actually fell? How can both things be true at the same time? If companies are struggling to find people with the right skills, shouldn't it be harder to fill roles, not easier?
Right, so that's the counterintuitive part. Job vacancy filling difficulty did drop. It's at 32% now, down from 46% just a year ago. And I think what's happening is this: businesses have stopped waiting for the perfect hire. Instead, they're shifting their strategy. They're hiring people and then training them. Look at the training investment numbers. 81% of London firms plan to increase training investment. That's a record high, up from 69% in 2023. So companies aren't necessarily replacing workers, they're upskilling the ones they have.
Okay, so the picture is widespread AI adoption creates skill requirements, but instead of everyone hiring AI experts, they're training their existing workforce. But let me dig into the actual skills themselves. What are these gaps? Are we talking about everyone needing to become a machine learning engineer, or is this something different?
Much different, actually. The survey breaks it down. 85% of firms using AI say it's changed their required skills, but the direction is interesting. They're not asking for more coding ability or data science expertise. Instead, they're emphasizing critical thinking and ethical reasoning. Basically, if AI is going to do the routine cognitive work, writing emails, analyzing data, generating code, then the humans need to focus on judgment, quality assessment, and making decisions that have real consequences. 60% of London firms say they lack advanced digital skills, 23% lack even basic digital skills. But what's accelerating is demand for skills like evaluating AI output, understanding limitations, and thinking about ethical implications.
That's a significant shift in how we think about skill development. But here's what I want to understand. Is this training investment actually happening, or is it just stated intention? Because there's often a gap between what companies say they'll do and what they actually fund. And more fundamentally, can you even train that quickly? We're talking about a shift from do the work yourselves to manage AI tools and make judgment calls about the output. That's a different mental model for a lot of workers.
Those are both fair questions. On the first one, whether it's actually happening, the data suggests it's not just talk. 81% increasing spend is meaningful, especially compared to 69% a few years ago. But you're right that stated intention and execution are different. We'll see whether those training dollars actually get deployed or if they get absorbed into overhead. On your second point about speed, I think it varies by role. If you're a marketing professional suddenly expected to use AI for copywriting and campaign analysis, the mental model shift is real but achievable in weeks. If you're in manufacturing or logistics and suddenly expected to oversee AI systems making operational decisions, that's a bigger change. But here's what the survey reveals. 20% of firms do plan to reduce staff due to AI reducing demand for entry-level and mid-career roles, so there is some workforce contraction, but it's minority. 80% are staying flat or growing headcount while upskilling.
So the macro picture is most businesses are keeping workers and training them. A meaningful minority is shrinking headcount. And across the board demand is shifting from execute tasks to evaluate AI output and make judgment calls. The question I'm left with is this sustainable long term? Because if you're a mid-career professional who spent 15 years getting good at a job, and suddenly that job is either being done by AI or fundamentally restructured, retraining might help, but there's also a real human cost there. And if 81% of firms are all trying to upskill at the same time, are there enough training resources, time, and patience for everyone to keep pace?
That's the harder question, and honestly, the survey data only tells us so much. What it does show is that London's labour market is adapting faster than a lot of people expected. Businesses aren't panicking en masse, they're responding rationally with investment and retraining. But you're right that there are winners and losers here. People who can adapt their thinking quickly, who already have strong critical thinking and judgment skills, they're probably going to be fine. People in routine-heavy roles without much upside for judgment or creativity, they're at genuine risk. And the other thing this reveals is that the skills gap is getting more acute even as more companies invest in training. 78% expect to need advanced digital skills in 2 to 5 years, up from 56% in 2023. So the training investment we're seeing now, it's essentially a race. Can companies upskill their people faster than skill requirements are rising? So, we just got word that Samsung Electronics is rolling out ChatGPT Enterprise and Codex to all of its Korean employees and everyone in the global device e-experience division. This is actually one of OpenAI's largest enterprise deployments to date. We're not talking about a pilot program or a select group of power users. This is company-wide, at scale, across research, development, manufacturing, marketing, and corporate functions. The scope here is genuinely significant.
That's a massive deployment. But what actually matters is what they're using it for. ChatGPT is one thing, it's a general-purpose tool. But Codex is more interesting, because it started as a coding tool, and now it's being used way beyond software development. What are they actually doing with it across these different functions?
That's exactly where this gets interesting. Yes, you've got software developers using Codex for what you'd expect, writing code, debugging, generating boilerplate. But the adoption pattern in Korea is striking. Since February of this year, they've seen 800% growth in Codex usage, and it's spreading to non-technical teams. Marketing teams are using it to build simple internal tools and websites without needing to hire developers. Manufacturing is using it to automate workflows and data processing. The security piece matters too. Samsung is using ChatGPT Enterprise, which provides full data protection, access management, and governance controls. So these teams get powerful AI capabilities without the worry that their internal data is leaking out.
800% growth in a few months is remarkable. But let me push on this. Is Samsung seeing real productivity gains, or is this adoption happening because the tools are new and exciting? And more fundamentally, what's the relationship here? Samsung is both a customer of OpenAI's software and a supplier of critical AI hardware. They're making the memory chips that power OpenAI's infrastructure. That's not a coincidence, is it?
Not a coincidence at all. This is a two-way relationship that reveals something important about how AI economics are reshaping. Samsung has an incentive to deploy OpenAI's tools widely through their organization because that creates adoption data, use cases, and real-world validation. OpenAI gets a high-profile customer, and both companies benefit from the integration story. But you're right that there's a deeper symbiosis here. Samsung supplies the advanced memory semiconductors that OpenAI needs to scale their infrastructure, while Samsung employees are using ChatGPT Enterprise to transform their workflows. Samsung's fabs are supplying the compute that makes ChatGPT possible. That's a tight loop.
So the question becomes, what does this tell us about the future of AI economics? Are we moving toward a world where hardware suppliers and software vendors are bound together, where being competitive in AI means controlling both the chips and the applications? Because if you can't supply the memory, you can't compete in inference at scale. And if you don't have applications that create demand for that memory, you're just building commodity hardware.
Right, and Samsung's in a unique position because they can do both. They're not just an AI customer like most enterprises, they're an essential supplier to the people making the AI systems. It means Samsung has leverage and optionality, but it also reveals something about the concentration of value in the AI stack. The companies that win are the ones that can span multiple layers: hardware, software, deployment, applications. Samsung's deployment of ChatGPT Enterprise isn't just about productivity improvements for their workforce, it's a strategic move that tightens their relationship with OpenAI and validates their position as an essential part of the AI supply chain.
And what does this mean for everyone else? If you're a company that wants to deploy cutting-edge AI, but you don't have a supplier relationship with the chip makers, are you at a disadvantage? Or if you're a smaller player trying to compete with OpenAI, do you need your own hardware supplier to survive?
That's where it gets hierarchical. The Tier 1 players, OpenAI, Anthropic, potentially others who can bundle hardware, software, and deployment, they have structural advantages. But there's still room for specialists. You can be phenomenal at one layer and partner with others. Samsung isn't trying to build their own foundation models to compete with OpenAI. They're betting on partnership and integration. The question for other enterprises is, do you have the leverage to negotiate favorable terms? Samsung does because they're a supplier. A typical enterprise doesn't, which is why the governance and data protection Samsung insisted on through ChatGPT Enterprise is so important. They're using their leverage to get security guarantees most customers would have to build themselves.
So the deeper lesson here is that enterprise adoption of AI isn't just about companies buying tools. It's about strategic positioning within the AI value chain. Samsung is using this deployment to deepen a symbiotic relationship with OpenAI, validate their own hardware roadmap, and create leverage for future negotiations. That's sophisticated business strategy layered on top of what looks like a straightforward software deployment. And honestly, that's probably where the real value is for Samsung. Not in the productivity improvements for individual employees, though those matter, but in the strategic positioning. This week saw some headline-grabbing talent moves. Noam Shazir joined OpenAI, Nobel Prize winner John Jumper just went to Anthropic, and there are rumors floating around about GPT 5.6. On the surface, it looks like a talent stampede, and people are asking, who's winning the AI race? But I'd argue the talent headlines are actually obscuring the real story, which is about capability positioning and where these companies are betting their R&D budgets.
Okay, so talent is a signal, but maybe not the signal everyone thinks it is. What's the actual story then? Because Nobel Prize winners and high-profile hires at OpenAI usually mean something is shifting.
Right, they do signal something, but the real competitive move happened a bit quieter. Anthropic just released 2 new models called Fable and Mythos, and these aren't incremental post-training improvements like we've been seeing. These are new, pre-trained foundation models. That's a different ballgame entirely. Pre-trained models are more intelligent, but also much more expensive to build because you have to process massive amounts of data from scratch. OpenAI has been focused on reasoning layers and post-training optimization. They're trying to squeeze more capability out of existing pre-trained models. Anthropic is saying we're investing in fresh pre-training, which gives us newer, larger, more capable foundation models to build on.
So you're saying the pre-training advantage is structural? If Anthropic has newer, fresher foundation models, they can use those to train the next generation, and OpenAI is working with older base models and trying to make them smarter through post-training and reasoning. Isn't that a temporary advantage, though? OpenAI could just do their own pre-training run, right?
They could, but pre-training is expensive and time-consuming. By the time OpenAI finishes a new pre-training run, Anthropic could be working on iteration 3. It's a tempo thing. The talent migration actually reinforces this. Jumper going to Anthropic, he's a materials scientist and computational biologist, Nobel Prize for protein structure prediction. Why would you hire him unless you're building something ambitious from the ground up? It suggests Anthropic is thinking big about new pre-trained models, not just tweaking existing ones. Meanwhile, Shazir to OpenAI probably makes sense for their reasoning and post-training work. He's an expert in language model optimization. Different strategic bets.
So, the talent is actually aligned with their capability strategies. But here's what I want to understand. If pre-training is so expensive, and Anthropic has the advantage there, how long can they actually maintain it? OpenAI has more revenue, more resources. Don't they eventually win by just outspending everyone?
Maybe, but not automatically. And this is where I want to bring in Midjourney, because it complicates the narrative. Midjourney just announced a medical ultrasound imaging device, 60-second full-body scans, affordable, preventative, targeting 1 billion scans per year. This is not a language model. It's real-world impact. And here's the thing. Midjourney is bootstrapped, profitable, 200 employees. They're making $200 million in revenue with 40 people. That profitability lets them fund moonshots without venture capital constraints. They're not trying to raise Series D from investors who want returns in 5 years. They can take weird bets that might take a decade to pay off.
I see where you're going with this. You're saying the winner of the AI race might not be determined by who has the most pre-trained models or the best reasoning layers. It might be determined by who can actually deploy AI to solve real problems and make money doing it. Is that what Midjourney is showing us?
Exactly. Midjourney proves that the most transformative AI breakthroughs might not come from the companies racing on the leaderboards. They might come from smaller teams building sustainable, profitable businesses and using that cash flow to fund adjacent moonshots. Meanwhile, OpenAI and Anthropic are locked in a capability race, pre-training versus reasoning, bigger models versus better training techniques. Both are important, both matter, but the real world doesn't just care about benchmark scores. It cares about whether you can make an ultrasound device that works, costs little to operate, and can scale to 1 billion scans a year. Midjourney is doing that. The question for OpenAI and Anthropic is whether their capability advantages actually translate into products that change the world, or whether they're optimizing for metrics that don't matter as much as we think.
So the talent stampede and the capability positioning, it's real, but it's also incomplete as a way to think about who's winning. You've got OpenAI betting on reasoning and post-training, Anthropic betting on fresh pre-training, and then you've got Midjourney off to the side, building something entirely different with sustainable economics. They're not even competing on the same dimension.
Right, and that's the messy reality. The headlines say OpenAI and Anthropic are fighting over talent and capability, but the actual competitive landscape is much more complicated. Pre-training advantage is real. Reasoning breakthroughs are real. But so is Midjourney's ability to turn AI into medical devices that save lives. All three of those things matter, and they matter differently depending on what you care about. If you're a researcher, Anthropic's fresh pre-trained models might be most important. If you're a builder trying to create a product, Midjourney's approach to sustainable profitability and real-world impact might be the better model to learn from. The talent movements are signals, but they're not the whole story. All right, we need to step back from the technical details for a moment and talk about something that's genuinely consequential: Europe's strategic position in AI. There's a scenario being discussed called Europe 2031, and I want to be clear from the start, this isn't speculative fiction. It's a narrative-driven extrapolation of current trends that's being treated seriously by people who understand European policy. The scenario is told through two characters, Caroline, who works in EU policy, and Christian, a German AI founder who moved to Silicon Valley a few years ago.
Okay, so these are real archetypes, not fictional constructs. What's the story? What does this scenario actually trace?
The core tension is this. Caroline stays in Brussels, working within the EU regulatory framework, convinced that Europe's values-based approach to AI is a competitive advantage. She points to DeepSeek R1, which emerged in January 2025 and showed remarkable efficiency gains. DeepSeek proved you could build powerful models without the sheer compute scale that American labs have been deploying. To Caroline, this is proof that efficiency beats scale, that Europe doesn't need to match Silicon Valley dollar for dollar. Christian, meanwhile, is in San Francisco watching a completely different landscape. OpenAI just released O3 Mini. The compute acceleration isn't slowing down, and the assumption among founders there is that AGI arrives in 2 to 3 years. Not maybe, not hopefully, as a working assumption for product planning.
So the scenario sets up a fundamental disagreement about what matters, efficiency or scale. And Caroline thinks Europe's smaller, more regulated approach can still compete. But Christian sees Silicon Valley accelerating regardless. That's a genuine strategic divergence. What happens next in the scenario?
By 2031, the scenario traces a collapse of that optimism. Europe never builds a competitive AI sector. The regulatory framework that Caroline believed was a strength becomes a disadvantage. You can't move fast, you can't attract the top talent, and you can't compete with companies that operate under different rules. Meanwhile, the assumption Christian had, 2 to 3 year AGI timelines, becomes the organizing principle for Silicon Valley's entire ecosystem. By 2031, that's starting to look correct. The efficiency gains that DeepSeek demonstrated turn out to be real but insufficient. China can't match US compute, so they can't scale up, and Silicon Valley just keeps accelerating. The deepest insight in the scenario is that DeepSeek R1 created false European optimism. It proved efficiency works, but it ignored that you still need massive compute to scale. Efficiency without scale is a dead end.
So the cautionary tale is specifically about mistaking one data point. Yes, you can be efficient for a strategic strategy, but that doesn't mean you've solved the fundamental compute gap. Is the scenario suggesting this is inevitable, or are there decision points where Europe could have course-corrected? Because that matters a lot for how we interpret it.
That's the right question. And I think the scenario is genuinely about policy failure modes. It's illuminating what decisions Europe would need to make to avoid this trajectory, precisely because the current trajectory looks pessimistic. By 2031 in this story, Europe faces a cascade of failures. No competitive AI sector, which means no economic value creation, which means you can't fund the welfare systems you've built your social contract around. You also end up in a position where you can't defend your own values because you don't have the technology layer to enforce them. You're dependent on American or Chinese systems to run your critical infrastructure, your healthcare, your financial systems. And the union itself becomes harder to hold together because individual member states start making separate deals with US or Chinese tech companies just to survive economically.
Okay, so the scenario isn't just about Europe losing an economic race. It's about sovereignty, the ability to enforce your own preferences, and the literal political cohesion of the European Union. That's a lot more serious. But here's my question. What would have to happen differently? What decision points exist where Europe could change course?
That's where the scenario becomes a kind of strategic roadmap in reverse. To avoid 2031, Europe would have needed to make completely different choices starting right now. You'd need to commit massive public investment in AI infrastructure, not through regulation, through capital. You'd need to create a European tech company with the resources and autonomy to move at Silicon Valley speed. You'd need to acknowledge that efficiency is not a substitute for scale, and that to compete, you might actually need to relax some regulatory constraints in the short term to build capability. But more fundamentally, you'd need to align on the belief that this is a survival-level competition. And right now, that's where the real gap lives. Silicon Valley assumes AGI in 2 to 3 years and structures everything around that urgency. Brussels treats AI as an interesting technology that needs responsible governance. Those are incompatible worldviews.
So the scenario is illustrating a crisis of belief as much as a crisis of resources. Silicon Valley is operating under one set of assumptions: rapid AGI, massive competitive advantage accruing to first movers, and Europe is operating under a different assumption, that this is a longer, more measured problem where good governance matters more than speed. Is that a fair summary?
That's exactly right. And the scenario argues that the belief gap itself is the strategic vulnerability. When everyone in San Francisco is planning products for a world with artificial general intelligence in 2026, 2027, that affects how they design, what they optimize for, what they're willing to invest in. When Brussels is still debating how to regulate language models responsibly, you're operating on different timescales. The scenario doesn't say Europe's governance approach is wrong per se. It says that if the AGI timeline is real, then governance-first approaches become irrelevant because the competitive and capability gaps have already determined the outcome.
But let me push back on the inevitability here. The scenario shows a failure path. But is there actually any evidence that Europe's timeline assumption is wrong? Or is this scenario assuming that Silicon Valley's belief in fast AGI is correct, and then extrapolating from there?
That's a crucial distinction. The scenario doesn't claim to know when AGI actually arrives. What it does claim is that the belief itself, in Silicon Valley, among the people making capital allocation decisions, is self-fulfilling. If you believe AGI is 2 to 3 years away, you structure your company, your hiring, your research, and your capital deployment around that belief. You take bigger risks, you move faster, you attract founders and researchers who believe the same thing. Meanwhile, if you believe AGI is 10 or 15 years away, you operate more conservatively, you build sustainable businesses, you follow regulation. The scenario's point is that we might not know which belief is correct, but we do know that the first worldview gives you a compounding advantage in the race, and by 2031, looking back, Europe's more cautious approach will look like strategic failure, regardless of whether AGI actually arrived.
So the warning isn't necessarily, a GI is coming in 2 years, Europe is doomed. The warning is, Silicon Valley is behaving as if a GI is coming in 2 years, and that behavioral difference is producing real capability gaps, and by 2031, those gaps are going to be decisive. That's actually a different claim, and it's harder to argue with because it doesn't depend on the AGI timeline being correct.
Exactly, and that's what makes the scenario powerful. It doesn't require you to believe in fast AGI. It just requires you to look at the current trends. The compute gap is widening. Silicon Valley has 10 times the R&D investment in AI. China is rapidly catching up on efficiency but lacks compute. Europe has strong values and regulatory frameworks, but no major AI companies. DeepSeek proved you can be efficient, but it didn't prove you can compete without scale. If you extrapolate those trends forward, not 10,000 years, just 5 years, you get to a place where Europe's strategic position is significantly weaker. And then the question becomes, is that acceptable? Can Europe live as a dependent on American AI infrastructure? Or does that create geopolitical and sovereignty risks that are unacceptable?
And that's perhaps the most uncomfortable implication for policymakers. It's not about whether the scenario is right or wrong in every detail. It's that the scenario makes visible the cost of inaction. If you do nothing, you get European dependence and erosion of sovereignty. If you try to compete, you need to make difficult choices, maybe relaxing regulations, maybe building national champions, maybe accepting that efficiency and responsibility can't be your primary strategy. Neither choice is clean.
So we've covered a lot of ground today. Forecasting pipelines, local inference debates, a parameter efficiency breakthrough, London's workforce transformation, Samsung's enterprise play, the talent competition between OpenAI and Anthropic, and Europe's strategic vulnerability. If I had to find a single thread connecting all of this, it's that we're no longer asking whether AI matters. That question is settled. 75% of London firms are already using it. Samsung is deploying it company-wide. Businesses are reorganizing around it. The question that actually matters now is, who controls the capability frontier, and who has the resources and speed to keep pace?
That's exactly it. And what's interesting is that this question has two very different answers depending on where you're operating. If you're a builder in the US ecosystem, especially someone bootstrapped and profitable like Midjourney, you've got asymmetric advantages. You have access to the latest models, you can move fast, you can experiment with hardware-software integration. But if you're a business in Europe relying on regulatory frameworks to protect you, or if you're depending on government intervention to keep you competitive, you're facing asymmetric risks. The capability gap is real, it's widening, and regulation alone can't close it.
And the London data actually illustrates that point really clearly. Businesses aren't waiting for government to tell them what to do. They're responding directly. 81% increasing training investment, 75% already adopting AI. They're making unilateral decisions to upskill their workforce because they can see that capability is becoming a competitive requirement, not a nice-to-have. Compare that to Europe's policy approach, still debating governance frameworks while the capability gap widens. The labor market is moving at one speed, policymakers are moving at a different speed entirely.
And here's what strikes me about the labor market data specifically. Most businesses aren't mass replacing workers, they're redeploying them. 80% are keeping or growing headcount. They're training people toward critical thinking and judgment, rather than routine execution. That's actually a healthier adaptation story than a wholesale automation wave. But it only works if the training keeps pace with capability changes. And right now, the fact that 50% report skills gaps, even as they're investing in training, suggests they're in a race they might be losing. The upskilling can't happen faster than capabilities are advancing.
Which brings us back to the structural question. Capability gaps are widening on every dimension. You've got pre-trained versus post-trained models, local inference versus cloud-based, open source alternatives versus proprietary systems, bootstrapped profitable companies versus venture-backed races for capability. And each of those gaps translates into real competitive advantages or disadvantages. The companies and builders who win are the ones who can operate across multiple layers, who can choose their models intelligently, who can run local inference when it matters, who can access cutting-edge capabilities when they need them. That's not something you can buy through regulation. You have to build it or partner strategically.
So if we're thinking about the next 12 months, what does this actually mean? My sense is we're going to see continued divergence. Some companies and regions will accelerate. They'll invest in capability. They'll upskill aggressively. They'll make partnerships that matter. Others will fall further behind because they're still trying to navigate regulatory frameworks or waiting for government support. The London firms that are investing 81% more in training, some of those will come out of this stronger. Others will spend the money and still lose ground if they're not being strategic about which AI capabilities they're building around. And geopolitically, Europe's window for course correction is closing, not because it's impossible, but because the gap is compounding.
So let's step back and distill what we've actually learned today across these 7 stories. The first key takeaway is probably the most fundamental. The AI capability race is genuinely real and accelerating. It's not hype, it's not just benchmark noise, we're seeing it across multiple dimensions simultaneously. Pre-training advantage matters, Anthropic's fresh models versus OpenAI's post-training focus, reasoning breakthroughs matter as we saw with O3 Mini, and efficiency compression matters, even if Vibe Thinker 3B is somewhat narrow in its application. What's clear is that winners in this space are pulling ahead, and they're doing it systematically. The gap between the leaders and everyone else is compounding.
And that capability gap translates directly into real-world impact. We saw it with Midjourney's medical ultrasound device. We're seeing it with Samsung's aggressive deployment of ChatGPT Enterprise across their entire organization. These aren't theoretical advantages, they're becoming competitive necessities. The companies that understand their capability surface, where they can run local inference, where they need cloud-based reasoning, which models are suited for which tasks, those companies are going to extract value. The ones that don't understand their capability options are just going to be buying tools without strategy.
Which brings us to the second key takeaway. Enterprise adoption is moving much faster than workforce skills can catch up. And this is where the London data is so revealing. 75% of firms are already using AI. 81% are increasing training investment. But 50% still report skills gaps. So you've got this mismatch. Capability is arriving faster than humans can adapt. That creates real disruption. 20% of firms are planning headcount reductions. But it also creates opportunity. The companies that invest intelligently in upskilling, that understand the skills transformation is toward judgment and critical thinking rather than routine execution, they're going to come out ahead. But you have to move fast. This race is compounding too.
And that skills gap is actually an opportunity for a whole category of products and services we haven't even mentioned. Training platforms, AI literacy programs, decision support tools. There's going to be real demand from SMBs and enterprises that need to upskill their teams faster than they can do it internally. The London data shows that businesses recognize they need to move, they're committing budget, but they're probably not moving fast enough. That's a gap where new solutions can fit.
The third takeaway is geopolitical and structural. Fragmentation is real. Europe's regulatory framework and policy-first approach versus Silicon Valley's capability concentration and speed-first approach, these are fundamentally different strategies, and they're producing different outcomes. The scenario we walked through about Europe 2031 isn't inevitable, but it's tracing a failure mode that's plausible if current trajectories continue. The compute gap is real, the investment gap is real, the talent concentration in San Francisco and parts of China is real. If you're operating in a jurisdiction where policymakers are still debating governance and you're competing against companies that assume AGI in 2 to 3 years, you're racing under different rules. Some regions and countries are going to win in this environment. Others are going to find themselves dependent on foreign AI infrastructure, which creates sovereignty risks.
And that brings us to the fourth and final takeaway, which is practical. For builders, entrepreneurs, and business leaders, the question has fundamentally shifted. It's no longer, should we adopt AI? That's already decided. 75% of London firms are already using it. Samsung is deploying company-wide. The question now is, which tools, capabilities, and partners do we actually bet on? Do you use Ollama for convenience, or Llama.cpp for control and performance? Do you build on Anthropic's fresh pre-trained models, or OpenAI's reasoning-optimized approach? Do you develop in-house or partner? Do you run local inference or cloud-based? Those choices matter more than ever, because the capability landscape is fragmenting. There's no single right answer anymore. It depends on your specific problem, your constraints, your position in the value chain.